On its first so-called Super Thursday, the Bank of England announced its interest rate decision, published the minutes of its meeting, and released its inflation report all at the same time. So, what did we learn? I'm here with Ferdinando Giugliano, our economics correspondent, to find out. Ferdinando, there was a lot of excitement before this because this mass of data hasn't been released at the same time before. But in the end, we didn't really learn anything new, did we?
Well, there was some news. For example, there was a split, which was the first time. So the MPC, the Monetary Policy Committee, the nine-strong body which sets interest rate in the UK, split 8-1.
But they've been 9-0 till now.
Till now, since January, unanimously backing holding rates. Now there is one dissenter, but actually markets and analysts were expecting more than one dissenter. We were looking at a 7-2, even 6-3 split. And all we got was Ian McCafferty, one of the external members, saying rates he thinks should go up by 25 basis points right now. But everyone seemed to be still following the party line, which is rates will go up, but not now.
So more dovish maybe than some people expected. And why is that?
Well, I think the key reason for this is because inflation is actually coming up a lot more slowly than the bank thought. At the moment, we are at 0 in June, but the bank is saying because oil prices have fallen again over the last few months, and because sterling is proving so strong, making the cost of import a lot cheaper, that means that in the near term, inflation will be lower than the committee and that the bank had thought. They have halved their inflation forecast for this year. So that's the main reason why the committee is sounding quite dovish, or a bit more dovish than we thought they would.
Well, what does this do to the credibility of the Bank of England and the governor, especially because Mark Carney seemed to be going out of his way a couple of months ago to try to signal to the markets, be ready for a rate rise, it could happen soon or sooner than you think. But now he seems to have backtracked on that.
Well, it's interesting because in the press conference, the governor once again said we're getting closer to an increase in interest rates, sounding a little bit more hawkish than the report just a few hours before, which had been released just an hour before. However, his explanation is very clear. It's basically, I have never said interest rates will go up by the end of the year. If you look at, for example, a speech which he gave just a few weeks ago at Lincoln Cathedral, he said the decision on when interest rates will go up will come around the turn of the year, which can mean a lot of different things. It can mean November, it can mean February. So he's really, he's being quite vague, and also he's saying all of this is, now we are in data-dependent territory. That was his message. Other message to markets is like, we can't predict an exact time because it will depend on how the economic picture pans out.
I see, and this is sort of what he was saying when he first introduced forward guidance, that it all depends on certain conditions. But that hasn't gone down all that well with market observers. Aren't there people who think that he's been zigging and zagging and being more confusing than helpful?
Well, there are some people who are, if you look at the analyst notes, there are some people who talk about the capricious governor. But ultimately, I think the point which he's trying to make is that really it's data which will drive the Bank of England's hand at the moment. And the reason why they're striking a slightly more dovish note at the moment is because actually there's something good which is happening, they think, to the British economy, which is productivity. So wages are going up, that's true, but the Bank of England thinks productivity is also growing. And if that is the case, that leaves a little bit more space for wages to go up without having some sort of bad inflationary pressures building up in the economy, which is why probably the bank thinks it has a little bit more space than it thought.
So, in a sense, this maybe looser than we expected monetary stance is not a sign that the economy is doing more weakly than we thought, but perhaps that it's doing better in a way that allows them to wait. What is the outlook that the Bank of England is giving for the economy for the next year or two?
Well, it seems quite a positive outlook. Growth has been revised up today to 2.8% for this year, basically where they thought it would be for the next few years. But one thing which the bank was very excited about was investment. They thought the investment in the economy, which is something which hadn't really happened in the early phase of this recovery, is coming back, and is coming back strongly. So they think investment, domestic consumption, because of low oil prices and high wages, will be helping the economy. On the downside, we have trade, which the bank seems to almost have given up hope on. and fiscal consolidation, which is the other headwind to the economy. But overall, I think the Bank of England seems to have a pretty positive assessment of the economy, the British economy.
Well, that seems to be good news. It does feel a bit for us as if we're sort of waiting for Godot, waiting for the interest rate hike that never comes. My bet is that you and I will be back here again before interest rates go up.